Welcome back to Common Sense Investing, where we make money, markets, and wealth simple to understand. Today's video is personal. I want to share 12 investing lessons I wish I knew when I started out. These lessons could have saved me years of frustration, bad decisions, and unnecessary risk. If you're serious about building long-term wealth, these principles can help you avoid the common traps most investors fall into and build a more confident, disciplined approach to money. Lesson 1: Valuation isn't everything. When I first began investing, I thought buying low price-to-earnings ratio stocks was the key to success. The logic was simple: if it's cheap, it must be a bargain. But over time, I learned that valuation doesn't tell the full story. A company like Netflix in 2016 looked expensive, trading at a PE ratio above 300, while others sat around 15. On paper, Netflix was overvalued, but in reality, it went on to multiply several times over. A cheap stock can stay cheap if the business doesn't grow, while an expensive one can keep rising if earnings compound over time. The right question isn't, is it cheap, but why is it expensive? Sometimes the market is pricing in future growth, not past performance. Lesson 2: Understand where returns come from. Every dollar of return you earn comes from three places: earnings growth, valuation changes, and shareholder payouts like dividends or buybacks. Many investors only look at price charts, but price is just the surface. Over time, share prices tend to follow earnings. If a company compounds its earnings at 12% a year, the stock price will likely reflect that growth in the long run. Once you grasp that, you start thinking like a business owner rather than a trader chasing numbers. Lesson 3: Build a network of investors. Investing can be lonely when you're trying to figure things out on your own, reading articles, doubting yourself, and second-guessing every move. But when you connect with other investors, you accelerate your learning. You get to see different perspectives, challenge your assumptions, and hold yourself accountable. The conversations you have often teach you more than any book can. Your network compounds just like your portfolio, and the more you invest in relationships with thoughtful people, the better your decisions become. Lesson 4: Ride the right megatrends. You don't have to predict the future to succeed in investing, but it helps to recognize where the world is heading. Think about the last 20 years: cloud computing, smartphones, streaming, electric vehicles, and artificial intelligence. Investors who understood those trends early and found solid businesses within them did incredibly well. The trick is not to chase hype but to identify industries with real growth and companies that have durable advantages. A great company in a growing field can ride that wave for years, but even a booming industry can destroy returns if there's too much competition or too much capital flowing in. Pick your trends carefully and hold them with conviction. Lesson 5: Master investor psychology. The market isn't your biggest enemy, you are. The emotions of fear and greed ruin more portfolios than bad analysis ever will. We panic when prices drop and become overconfident when they rise. The key is to stay rational when everyone else is emotional. Investing success depends less on intelligence and more on temperament. If you can look at a 30% drop and see opportunity instead of disaster, you've developed real discipline. The market rewards patience and punishes emotion. Lesson 6: Avoid hype and fads. Every few years, the market gets caught up in a story: crypto, meme stocks, AI, you name it. Prices skyrocket, everyone gets excited, and then most of it crashes back down. Zoom during the pandemic is a perfect example. It soared 600%, then fell below where it started. Hype brings attention, not returns. The smartest investors focus on fundamentals, not fads. When the crowd rushes into the same trade, that's your signal to look elsewhere. Often, the best opportunities are hiding in the places no one is talking about. Lesson 7. Stay humble. A few wins can make you feel invincible. You start thinking you've cracked the market's code, and that's usually when you get humbled. The truth is, no one ever fully masters investing. Even the best make mistakes, and markets can surprise you in ways you don't expect. Staying humble keeps you cautious and grounded. Remember, preserving your capital is just as important as growing it. As Warren Buffett said, the first rule of investing is don't lose money, and the second rule is don't forget rule number 1. Lesson 8. Fight confirmation bias. Once you like a stock, it's easy to only pay attention to information that supports your belief. But that's dangerous. The best investors deliberately seek out the opposing view. Ask yourself, what could make me wrong? When you research, read both the bull and bear cases. If the bear case doesn't shake your conviction, then you probably understand the business well enough. Being wrong is inevitable, but staying wrong is a choice. Lesson 9. Keep it simple. Many investors love complexity because it sounds impressive, using options, leverage, or complicated models, but simplicity often wins in the long run. The wealthiest investors in history built fortunes by sticking to basic principles, buy quality businesses, pay fair prices, and hold for the long term. Simplicity removes noise and emotion. You don't need 50 stocks, you need a few that you understand deeply and believe in enough to hold for years. Lesson 10. Think for yourself. We live in an age where financial advice is everywhere: YouTube videos, TikTok gurus, newsletters, social media. Everyone has an opinion. But borrowed conviction fades quickly. When your stock drops 30%, someone else's confidence won't help you hold on. Do your own research, form your own opinions, and trust your own process. Independent thinking is one of the few real advantages individual investors still have. Lesson 11. Embrace discomfort. Every great investor has gone through painful drawdowns. Peter Lynch, Warren Buffett, Charlie Munger, all of them have watched their portfolios fall by 30, 40, even 50%. That's not failure, it's the price of admission. The market will test your patience, conviction, and mental strength. If you can stay calm through the storms, you'll earn the rewards that come with long-term compounding. Volatility isn't something to avoid, it's something to endure. Lesson 12. Enjoy the journey. When I first started, I was obsessed with numbers, returns, ratios, charts, and benchmarks. Over time, I realized that investing isn't just about getting rich. It's about learning. It teaches patience, discipline, and humility. It forces you to understand how the world works, how businesses grow, and how human behavior shapes markets. Every mistake is a lesson, every win a reminder that progress takes time. The process itself, watching your knowledge compound, is one of the most rewarding parts of investing. If these lessons helped you, share this video with someone who's just beginning their investing journey. And if you want more simple, practical insights that make you a smarter investor, subscribe to Common Sense Investing. Wealth isn't built overnight, it's built over time, through patience, discipline, and common sense. Thanks for watching, and I'll see you in the next one.